How to earn higher returns while investing in equity. Number 1. Fundamental analysis. When it comes to research, not everyone in the world has the temperament and mentality to conduct thorough technical analysis and invest on the basis of it, but we can all read correctly. All of the world's greatest investors have been genuine fundamental investors, from Warren Buffett to Charlie Munger. All have amassed vast fortunes by thoroughly understanding and researching all aspects of the businesses in which they have invested. Regardless of the size of the corpus, as an investor, it is always preferable to invest gradually rather than all at once. The aforementioned event is what is known as a black swan event, a rare occurrence that occurs only once in a lifetime, and expecting it to reoccur is simply stupidity. Instead, we should structure our portfolio so that, even if the aforementioned rare occurrence occurs, we are well positioned to capitalize by increasing the amount invested in that particular month or year. Number 2. Small versus large companies. Small capitalization companies have outperformed large capitalization companies in both the US and international markets, according to the performance histories of US companies since 1926 and international companies since 1970. Because they are less established, smaller companies carry a higher risk than larger companies over time. They are riskier loan candidates for banks because they have smaller operations, fewer employees, less inventory, and in most cases, no track record. However, an investment portfolio that favors small to medium-sized companies over large cap stocks has historically produced higher returns than one that favors large cap stocks. From 1926 to 2017, US small companies outperformed US large companies by an average of 2% per year. Using the same small cap theory, international small companies outperformed international large companies by 5.8% per year over the same time period. Number 3. Don't run after tips. Almost 9 out of 10 people you'll meet go into the markets thanks to a tip from a well-wisher or an insider. Logically, why would an insider reveal a listed business know-how in public when even our local samosa vendor is reluctant to reveal his recipe? Running after tips without first conducting your own research can be disastrous for your trading account. Instead, before investing one's hard-earned money in a company, you should do extensive research on it. Number 4. Managing your expenses. The way you invest your portfolio has a direct impact on the cost of your investments, as well as the overall investment return that you receive. Active management and passive management are the two main ways to invest. Active management is significantly more expensive than passive management. The cost difference between active and passive management is typically at least 1% per year. Active management is typically much more expensive than passive management because it necessitates the expertise of high-priced research analysts, technicians, and economists all looking for the next best investment idea for a portfolio. Because active managers must pay for fund marketing and sales costs, they typically charge a 12b-1 annual marketing or distribution fee on mutual funds, as well as sales loads, to ensure the Wall Street brokers sell their funds. Passive management is used to reduce investment costs and avoid the negative consequences of being unable to predict future market movements. In contrast to market timing and stock picking, index funds use this approach to own the entire stock market. Most active managers fail to consistently outperform their respective benchmarks over time, according to sophisticated investors and academic professionals. So, why incur the extra costs when passive management is typically 3 times cheaper? Number 5. Diversification is good, not over-diversification. While putting all of your money into one stock or sector may be too risky, diversifying your investments is prudent and advantageous in the long run. Over-diversification, or investing small amounts in everything you see on the other hand, can be detrimental to your portfolio's long-term growth. This is why it is preferable to invest respectably in a small number of companies rather than modestly in a large number of companies. If you do the latter, your gains from one stock will inevitably be offset by losses from others. Number 6. Always know how much you can afford to lose. We cannot emphasize this enough. A layman investor would know when to exit a stock, for example, at a profit of 20 to 30%, but would not know when to exit if it went downhill. Instead, he'd rather invest more in it in the hope that it will reverse the course. This is the most common and dangerous error to make. If we simply reverse this scenario and the investor knows how much he can afford to lose before making an investment, he will have more opportunities to invest, reflect, and improve. And not having a maximum profit cap would allow him to truly enjoy multi-bagger gains and compound his portfolio multiple times. Number Number 7. Rebalancing. A portfolio will drift away from its original asset class percentages over time and should be brought back into line with the targets. After a successful stock market rally, a 50-50 stock-to-bond mix could easily become a 60-40 stock-to-bond mix. Rebalancing is the process of returning the portfolio to its original allocation.